Welcome back to my YouTube channel. Content number 1. The world's greatest opportunity machine. The stock market is the greatest opportunity machine ever created. I believe that everyone should have access to the stock market, not just the rich and privileged. That's why I make this video. There is a place for everyone and every strategy in the stock market. You can invest in stocks, holding them for many years and pocketing their dividends. You can also trade stocks. You can day trade them, swing trade them, or short them, bet that a stock is going to go down instead of up. Don't ever let anyone tell you what you can or cannot do with stocks. After watching this video, you may even come up with your own original way of profiting from the stock market that no one has ever used before. In this video, I will give you an overview of many different approaches to the stock market. When you are first getting started, you should try out many different trading and investing strategies and see what works for you. Each one of us has a different psychological makeup and approach to risk. Some love the quick dopamine hits that come from trading. Others just want to live their lives and get rich slowly and quietly without any stress. There is room for both types of people in the stock market. I would just urge you to learn how the stock market actually works. Many people never take the time to learn this. Many people like to yell at the stock market and tell it what to do. The stock market is a complex emergent system. It won't listen to you or to anyone else. It's like the weather, it just does what it does, so you might as well get used to it. Take the time to learn how the stock market really works. To repeat what I said at the beginning of this video, the stock market is the greatest opportunity machine ever created. Unfortunately, most people never learn how to harness its energy to create wealth. You are clearly not like most people. You are watching this video because something in the title, thumbnail, or video description resonated with you. I believe that you are destined for something greater. You know that trading and investing are skills that can actually be learned. And you are ready to put in the time and effort to make that happen. That makes you my ideal kind of reader. I want to help you to get rich. The stock market has been really good to me and my family. So watch this video slowly and let its lessons sink in. Watch it again after you have had your first big losing trade. Or just watch it whenever you need a little inspiration. You can also subscribe to my YouTube channel, KK Vlogs or KK Trading, and follow along as I tell you what I'm seeing in the markets every week. I hope that you find this video helpful. I wrote it for the person who knows little or nothing about the stock market, but has the intellectual curiosity and hunger to learn. Let's get started. What exactly is a stock anyway? A stock is a share of ownership in a company. When I buy 100 shares of McDonald's, I become a partial owner of the company. I become a shareholder. If I had enough cash, I could simply buy up every share of McDonald's, and then I would own the entire company. I would be the emperor of burgers. Here is another way to think about it. McDonald's is like a pie that has 765,317,332 slices, shares outstanding. As I am typing these words, each of these slices is valued by the market at $187.62. That's what we mean when we say that the stock is trading at 187.62. Now let's take the total number of slices and multiply it by the price per slice. We get about $143.58 billion. That's the current total value of this pie that we call McDonald's. Another word for this is market cap or market capitalization. When we hear that Apple has become the biggest company in the world, we usually mean that it has the highest market cap. On 3rd October 2018, Apple had a market cap of $1.103 trillion. Today, 20th May 2019, its market cap is $840 billion. A company's stock price and market cap will move around a lot over time. This is because all of the world's smartest minds and computers are constantly processing new information and collectively deciding what a company is worth. By buying or selling a company's stock, these traders and investors push a stock's price to where it should be trading based on all known information about the company. Sometimes the market is temporarily wrong. In 1999, Pets.com was valued at about $300 million. A year later, it was valued at zero, as the company went out of business. In 1996, Apple was valued at less than $3 billion. Then the company brought back Steve Jobs, who introduced the iPod.com and the iPhone. The price of Apple's stock, and hence its market cap, first slowly and then quickly ramped up as the market began to figure out how successful and profitable these devices would be. The stock market adjusts to new information. That is one thing that makes stocks wiggle around. Stocks also move based on the laws of supply and demand. If a lot of people want to buy a stock, the share price will move up. Maybe those people are overly optimistic, but their buying will still cause the stock to move up. Then if a very large investor comes in and starts to dump his stock, the price of the stock will move down. The stock market does something similar. It tries to figure out what is most likely to happen over the next 3 to 6 months and then prices stocks accordingly. That's why we say that the stock market is a forward-looking mechanism or discounting mechanism. In early 2009, the US economy was still in really bad shape. Everyone was still losing their homes and jobs. Even so, the stock market began to move up off of its lows. Then it really began to rally. This confused a lot of people who were looking out of their windows and still seeing bad economic conditions. But what the stock market was doing was pricing in an economic recovery, which turned out to be correct. The same kind of thing can happen with an individual stock. Sometimes a stock will report great earnings. I tell everyone that it had a good quarter and made a lot of money, but still fall sharply the next day. It does this because traders are reacting to something else in the earnings call or in management's forward-looking statements. The stock is skating to where the company is going to be in a few months. An inexperienced trader will be tempted to buy a stock like this when it is down, but this is almost always a bad idea. It can take time for new information to get priced into a stock, which means that this stock could continue to move lower for days or even weeks. The reverse can also happen. A company may report much higher than expected earnings. The next day, the stock gaps up, opens up much higher than where it was trading the previous day. Then the stock continues to move higher for a few days or even weeks. This happens because the big institutional players, mutual funds, pensions, hedge funds, are buying more shares of the stock and driving it closer to its new fair value price based on the new information that came out in the earnings report and call. When one is buying millions, or even billions, of dollars worth of stock, as these players are, one cannot do it simply by pressing a button. It can take hours, days, or even weeks. In a later chapter, I am going to show you how you can make money by taking advantage of these slow, lumbering giants. But for now, I'd like to stick to the basics. In the next video, I will show you how to open up a brokerage account and buy your first stock.
It's cross finger